Welcome back to State Pension Update. Imagine a future where, starting next year, the government could never raise taxes on your pension again. It sounds almost too good to be true, but that is precisely what the Labor Party is promising through a brand new pension tax lock. This policy has the potential to reshape how millions of pensioners, savers, and households across the UK manage their retirement income. It offers a sense of reassurance at a time when families are struggling with rising living costs, inflation, and soaring energy bills. Yet, as with any government initiative, there is more to the story than what meets the eye. Beneath the surface, there are small but important details that could quietly affect how much you actually take home. Understanding these details is essential for anyone relying on pension income or planning for retirement. So what exactly is a tax lock? Simply put, it is a government promise, a public commitment that certain taxes will not be increased and certain rules will remain unchanged for a set period. In the case of Labor's pension tax lock, the government is pledging not to raise taxes on pension income, private retirement savings, or state pension benefits for the duration of the current parliament. Essentially, they are saying, we will not take a larger share of your pension. This is undeniably comforting news for retirees, especially those who depend on their pension as their primary source of income. But as always, the true impact of such a promise is revealed in the finer details. In practice, the tax lock works alongside existing pension rules. For those already receiving the state pension, payments will continue to rise each year in line with the triple lock. This rule ensures that pensions increase by whichever is highest: inflation, average earnings growth, or 2.5%. Labor has confirmed it will maintain this system, meaning pensioners can expect another increase around April 2025, likely between 4 and 5%, depending on the final inflation figures. The pension tax lock ensures that these higher payments won't be reduced by new taxes or changes to tax thresholds. For people with private or workplace pensions, the news is equally positive. The 25% tax-free lump sum, the portion of a pension you can withdraw without paying income tax, will remain intact. Many had feared Labor might reduce this benefit to generate additional revenue, but under the new lock, this change is off the table for now. While all of this sounds reassuring, the picture is not entirely straightforward. Some analysts caution that the tax lock could limit the government's flexibility in future budgets. By committing to freeze pension-related taxes, Labor may have less room to respond to economic shocks or to fund public services if growth slows down or inflation remains high. The Treasury has confirmed that the lock will last for the entire term of the current Parliament, up to 5 years. During this period, there will be no increases to pension income taxes, no new charges on withdrawals, and no reductions in tax-free allowances. For pensioners, this brings stability and predictability, but for the government, it narrows the options for raising revenue when needed. Essentially, it is a trade-off: security for retirees versus flexibility for policymakers. Who stands to benefit most from this policy? First, state pensioners are the primary beneficiaries. Many rely solely on their pension, so knowing that their payments are protected from tax increases provides crucial peace of mind. Second, middle-income retirees also gain. Those with modest private pensions or savings slightly above the personal allowance will retain more of their income each month, as no new pension taxes or threshold changes are expected. Third, younger workers contributing through auto-enrollment pensions can take comfort in the long-term stability this policy signals. It reassures savers that their contributions and accumulated retirement funds will not suddenly be undermined by changes to tax relief or pension rules. Essentially, the government is sending a message: your pension is safe and your retirement plans are protected. However, not everyone is convinced that this policy is purely about protection. Some economists argue that it is a political move aimed at building trust rather than a long-term financial solution. They point out that previous governments have introduced similar tax lock promises, only to later make subtle adjustments. For example, instead of raising tax rates, authorities might freeze tax thresholds, gradually pushing more people into higher tax brackets, a phenomenon known as fiscal drag. This means that even with a tax lock in place, pensioners could still face higher tax bills over time without any formal increase in rates. Financial experts advise examining the structure of the policy carefully once full details are released to understand how it could impact individual retirement plans. Looking at the bigger picture, the pension tax lock is also a response to the UK's aging population. By 2030, nearly 1 in 5 people in the country will be over 65, meaning more individuals will draw pensions while fewer workers contribute to the system. This demographic reality has created public frustration over years of shifting pension rules, from changes in lifetime allowance limits to evolving tax relief regulations. Labour's proposal is an attempt to rebuild confidence in the system by promising that pension savings will not be targeted to balance the books. It also sends a signal that stability and predictability are priorities, reassuring retirees and savers that the government is focused on protecting their financial future. So, what happens next? The pension tax lock officially begins in April 2025, coinciding with the new tax year. Before then, the government is expected to publish full details, outlining which taxes are covered, how the lock will be enforced, and any exceptions that might apply. One debated area is whether income tax thresholds for pensioners could remain frozen. This wouldn't technically break the lock, but as pensions increase with inflation, it could mean some retirees end up paying more tax over time, even without any rate increases. For working families and younger savers, the lock also provides stability, allowing long-term retirement plans to continue without fear of sudden policy changes affecting savings incentives. Yet, the overall impact will still depend heavily on broader economic trends. So what can you do right now to prepare? If you are retired or nearing retirement, it's wise to review your income plan, ensuring your pension withdrawals and savings strategy align with the latest allowances. If you are still working, continue contributing to your pension, knowing this new lock helps protect the long-term value of your savings. And for anyone managing a household budget, this is a good time to reassess your financial priorities, savings goals, and spending plans. The more you understand how these policies affect you, the better equipped you are to make informed decisions and secure your financial future. At its core, the pension tax lock isn't just about avoiding higher taxes. It's about fostering financial confidence. It's about giving retirees the assurance that the rules won't suddenly change in the middle of their retirement journey. With careful planning and awareness, this policy could bring much-needed stability to millions of pensioners and savers across the UK. Thank you for watching State Pension Update. If you found this information useful, please like, share, and subscribe so more pensioners and savers can stay informed. Stay secure, stay confident, and we'll see you in the next update.